Welcome to Phillip Futures Weekly Market Watch. I'm Aftar, Senior Commodities Manager at Phillip Futures. Commodity prices this quarter are still influenced by a mixture of both macroeconomic factors and its own fundamentals, as was the case for most part of last year. The European sovereign debt issues and the Middle East geopolitical risks still present an overhang on commodities, influencing traders as they try to work out clearer direction trends that commodities move in. Nevertheless, we expect some measure of stabilization in economic markets going towards the end of this quarter and into the next. By then, fundamentals as thin inventories, low stock-to-use ratios, weather conditions, and demand growth would be expected to dictate trends rather than macro factors. Some commodities such as crude oil and gold are more influenced by macro factors rather than fundamentals or technicals. Others, like the agricultural market, tend to follow fundamentals closely. Therefore, looking at different commodities, one would deduce different price patterns. Let's take a look at energy. The crude oil markets, specifically the Brent crude, has broken out of their range-bound trading due to escalating geopolitical tensions in the Middle East and the halting of Iranian supply to Europe. Although on the supply side, OPEC oil supply has reached a 3-year high due to an increase of Libyan output, OECD's inventories have in fact fallen below the 5-year average. This primarily indicates that the markets are tight and that the strength in demand is stronger than expected. Our outlook is bullish in the near term. The outlook for base metal prices has also remained positive. As the global industrial sector slowly picks up, there is strength in global growth momentum and a lower probability that the Chinese economy will go through a hard landing. On the precious metal market, however, gold is searching for the next move as it wrangles between strong physical buying and a stronger dollar. Going forward, the top trades later this quarter and the next is expected to come from the agricultural sector. Prices of soybeans and corn have started to increase in response to deteriorating South American crop prospects. Stressful weather conditions in South America have started to reduce the production potential of both the soybeans and the corn crop. Because of irreversible crop damage in the major South American producing countries of Brazil and Argentina, we have reduced our soybean crop estimates significantly. Although there has been some rainfall this month and more is forecasted soon, it would come too late to be beneficial to the thirsty crops. Besides concern about the corn and soybean crop in South America, there are also concerns about the rapeseed crop in Europe, which has helped fuel a sharp 6% rally in rapeseed oil over the past month. Worries over the state of emerging crops in Europe and the Black Sea following deep freezes in these areas have sparked the price rally. Nevertheless, following the steep price climb, several key chart indicators are signaling that this market has overstretched itself to the upside and is due for a correction or a spate of consolidation. With the rally in rapeseed prices, interest has come back among traders to other oilseed markets as well. Soybean oil looks set to be the next market to watch on the back of reduced soybean production prospects in top exporter Argentina and a likely soybean acreage reduction in the next crop in the United States in 2012. Besides these supply concerns, demand for soybean oil from China is expected to remain strong owing to insufficient domestic production and reduced stocks. Chinese imports of oilseeds are set to rise sharply 15% in this year. Thank you for watching. Tune in to next week's Phillip Futures Weekly Market Watch.